This was the biggest corporate lie in American history. A company once valued at $70 billion collapsed into bankruptcy almost overnight, wiping out the savings of thousands of employees and shaking Wall Street to its core. And yet, the executives who built that lie walked away with millions. This wasn't just fraud. This was a blueprint of how money and power create fantasies of wealth, feed them to the public, and then vanish when reality comes crashing down. The name was Enron. And if you think this story is just history, you're wrong. Because the tricks that built Enron's empire are alive and well today. To understand how Enron rose so high and fell so hard, we need to go back to 1985. A man named Kenneth Lay merged two pipeline companies to form Enron. But Lay didn't just want to move gas. He wanted to trade it like a stock, and the timing was perfect. Deregulation was sweeping America, opening up energy markets. Enron positioned itself as a pioneer, trading energy contracts and promising to revolutionize the industry. Wall Street loved it. Politicians celebrated it. Fortune magazine named it America's most innovative company for 6 years straight. At its peak, Enron was the 7th largest company in the United States. It wasn't just selling energy anymore. It was selling the future. It claimed it could create a market for anything. Broadband, water, even the weather. It became the poster child of the 90s boom, riding a wave of hype. But behind the curtain, the empire was built on lies. The real genius wasn't in creating new markets. It was in manipulating accounting rules to fabricate profits that didn't exist. The core trick was something called mark-to-market accounting. Normally, a company books revenue when it actually earns it. Enron didn't want to wait. With mark-to-market, it could book the entire projected profit of a deal on the day it was signed, even if that money wouldn't show up for years, if ever. Imagine signing a 20-year contract to build a power plant. Enron would record all 20 years of projected profit immediately. On paper, they looked like they were making a fortune. In reality, they were just cooking the books. But that was just the beginning. To hide massive debts from bad investments, Chief Financial Officer Andrew Fastow created a labyrinth of shell companies. Their purpose was simple: take Enron's debts off its balance sheet and hide them. It was financial smoke and mirrors, designed to keep Wall Street analysts singing Enron's praises. Inside the company, the culture was toxic. A brutal rank and yank system fired the bottom 15% of employees every year, forcing everyone to inflate numbers and exaggerate deals just to survive. The company's so-called innovations were equally hollow. Enron poured money into a broadband trading platform that never worked, but they booked profits anyway. Their massive power plant project in India was a multi-billion-dollar disaster. Yet Enron recorded profits the moment contracts were signed. It was a pattern. Hype the future, book profits today, and hide the losses tomorrow. While executives cashed out hundreds of millions in stock, the foundation was rotting away. By 2001, journalists and analysts started asking questions. The illusion was about to shatter. In the fall of 2001, the truth could no longer be hidden. In October, Enron shocked investors with a $680 million loss. The SEC launched an investigation. Within weeks, the shell companies were dragged into the light, and the paper profits evaporated. On December 2, 2001, Enron filed for bankruptcy, the largest in American history at the time. The fallout was catastrophic. Over 20,000 employees lost their jobs. Many had invested their entire life savings in Enron stock, which went from $90 a share to worthless pennies. Families saw their futures disappear overnight. Meanwhile, the executives who orchestrated the fraud walked away with fortunes. Kenneth Lay, Jeffrey Skilling, Andrew Fastow Adlead manipulated and enriched themselves, leaving ordinary people to pay the price. The scandal even took down Arthur Andersen, one of the world's top accounting firms, for helping cover it up. In response, Congress passed the Sarbanes-Oxley Act to prevent this from happening again. But it didn't stop the 2008 financial crisis, and it didn't stop the collapse of crypto empires like FTX. So why does Enron still matter? Because the same playbook is used over and over. Manufacture illusions of wealth, attract investors, cash out at the top, and leave the public with the losses. Your retirement, the corporate giant, built on lies NT Fund, Your savings, your trust in the system, all of it, is vulnerable when hype is rewarded over reality. Enron teaches us a hard lesson. Financial education isn't just about investing. It's about learning to see through the illusions. Real wealth is not a stock price on a screen. It's something that endures. Enron wasn't an exception. It was a preview, and it whispers a warning to anyone who still believes the system is designed to protect them. If this gave you a new perspective, hit subscribe. History has the answers, and I'll show you where to find them. Thanks for watching.